Okay, good morning again, Bob Trade Genius, the 19th of May. What I really wanted to talk about was the real golden and death crosses. You know, the one that you see on TV all the time is not right. It's actually, it's so delayed that it's actually worthless. And so there was a study done that looked at all data for all time periods for just hundreds of thousands of data points. And they came up with a moving average of the 13 and the 48 as being the most responsive to the highest ROI if you just traded the crosses. And so that's what I put up here because I was curious, because I was doing, on vacation or a little bit, doing a little research, and I just wondered what it would be, and it looks pretty interesting to me. And so looking at the chart here, I said, okay, well, I'm more of a trader than a long swing guy. I said, is there any opportunities to optimize this? And so I'm looking at this big deep dive here, right? You just never know what was going to end, so it's hard to front run those. And then it would have already been up from 22.45 to the crosses here. You would have been in this trade at 2600. You'd have missed 400 points or 40 ES points. So I just added a simple stochastic here of a 10.33, and then I added a 3 moving average on it just to get responsiveness to it. And what I found was really fascinating. So, as this is falling here, you should be short the market until you get a crossover. And then I use the 15 as a line here in case there's just a shake and bake and it fails again. And that would have put you in. You would have missed this day for sure, but you would have been in this day. And you could have held on until you got to here and you got a crossover, and you have to respect the crossover. You just can't make new rules. So you would have got out here, and then you would have got back in here again. And once you're in here and you got a cross back up, there's no reason to sell the Stokes, because one thing that I learned about trading stochastics is that finding bottoms are easier than finding tops. And so as long as the stochastics are staying above the 60 line, there's no real reason to trade out of them. But once it falls below 60, then it's probably a good idea to close your position and then let another buy signal come back in to get you back in the trade. And here would have been a dip trade. It did it again. Here's another dip trade. And then you would have probably closed out here. Okay, and that would have put you right at the top. And now we had to sell off here. Okay, we still haven't crossed. We've been crossing today, but it's not coming up over to 60. So if you go long on this using this signal here, you're likely to get a failure here on this thing and have it come back down. But we just don't know the future, so you're just speculating at this point. But this is the lowest it's gone, and it's starting to flatten out. These are V's here. When it looks more like this, it looks like these moves become a fail and drop again. So that's what my expectation is, that this is going to be a failed retest. But if you follow a signal like this, you'd have to take the buy signal on it and then quickly be able to escape the trade if it starts to roll over and reverse into a short position. So anyway, love to get your thoughts on it. It's really fascinating to me. But this is for sure for people who don't want to trade and they just want to have a long swing to manage their portfolio. This was the mathematical model that was back tested and as the best moving average crosses. This was just my playing around to look for optimization on an overdone move, because moving averages don't catch them. It takes a while for them to catch up, especially when they stretch like this. So anyway, I'll catch you guys later. I'll talk about some more stocks as the day goes on. Bye-bye.